Now let's look at a few important concepts driving the world of macroeconomics. As the word itself says, the macroeconomics is more and more specific to the country as a whole, the economic activity relating to the overall economy, overall country level, not at an individual consumer level. Whenever we deal with individual customers, individual businesses, the kind of demand and supply associated with them, we are dealing more on a micro level, which is covered as a part of microeconomics. So whenever we are talking about aggregate output, the entire output that is produced in the country, the prices not of one single good or service, but overall price levels in the country, the economic growth, again at a country level, on an average, what is the kind of growth rate? So whenever we are talking about the aggregated numbers across the country, we are dealing with the world of macroeconomics. So in the macroeconomics, the first and the foremost important point that we really need to understand is the concept of the gross domestic product, typically called GDP in short, which is a measure of the kind of economic activity in the country. And the way it is measured, the total value of goods and services that are produced in a country during a period. So probably within the last 1 year, the period is, let's say in the last 1 year, the goods and services that are produced in the country, the total value of them is what we call as the gross domestic product of that country. And this is a very important measure that talks about the size of the economy. We can talk about the percentage. It is expressed one in absolute dollar terms, and other it is expressed in percentage growth terms, because it's a measure. If the GDP is much higher, the economic activity in that country is happening on a very large scale and the economy is growing. But if the GDP has fallen, it shows that the economy is dull. So it's a very important measure, but a few things go as a part of the calculation. Only the newly produced goods and services, not the prior periods ones. Probably a building that was built 5 years back, that will not be, and it is resold, let's say this year, it will not be included as a part of the good and service produced in the country during the current period. So only newly produced goods and services, whereas a new building that is built in the current year, that would be included as a part of the GDP. So that is where we have to be very clear. The prior period products, whichever are manufactured in the earlier years or resold in the current year, they are not included as a part of the GDP. So even if something is produced in the current year, sold and again resold, the double counting of it does not happen. It's only counted once, because the fundamental is very clear. Only that good or service that is newly produced in the current year will be included as a part of the GDP, not the prior periods ones. Similarly, the transfer payments. See, generally, government pays a lot of welfare schemes and benefits to the citizens of the country. There could be a social welfare benefits. These are not something that are typically earned by the people. These are not something. These are provided by the government. Social welfare, unemployment, any kind of social schemes that are being announced by the government and being paid from the government to the individual, they are treated as transfer payments from the government to the individuals. They are also not included because they are not produced by the country during this period. Some past some past earnings of the government it is using to redistribute to the individual. It is not a new production. So the transfer payments are not included as a computation of the GDP. And even for the goods and services, only their final value is included. It doesn't mean, let's say, this is a raw material, it got produced into an intermediate good. This again went into a production and became a finished good. What we are saying is only the final value is included. These two are not included. This is not included, this is not included because it would double count. The value of this, if I take the value of this, if I take the value of this, then it looks as if the overall value of the goods and services is much, much higher. Either I take only this, which is what we call as the value of the final output that is produced, or I take the value added at each stage. Both of them could still mean the same. If I am considering this, then once it became an intermediate good, only the excess need to be considered or counted as a part of the GDP computation. Similarly, once it's an intermediate good and its value is something, when I'm considering a final finished good, I'm taking only the additional value added between these two as a part of the GDP computation. But overall, if you see, we are looking at only the final good and services, the value of which is included in the GDP. Either I do it in parts or I ignore these two things altogether and I take only this one. Either of them will lead to the same solution, but probably at different points in time. And the goods and services, there are some kinds of goods and services which are provided by the government. Probably the defense service, people don't pay for it. The police service or some kind of roads. The government spends on all these kinds of welfare schemes, but it may not typically charge people or it is not sold to the people. But even those are included as a part of the GDP, and because it's not sold to the public, the market value is not available for them, so they are typically included at the cost which is incurred to the government itself. But yes, the value of that also is included as a part of the GDP. Similarly, any rented houses, at the rental incomes which people are getting, the rental expenditure incurred by the people is typically taken as the value of that particular house during that particular period. But the owner occupied houses, they are not rented, there is no market value for them, but still based on the rented houses details, the estimated value for those owner occupied houses is computed and that value is included as a part of the GDP computation. So GDP computation typically is a very fairly extensive process, including the newly produced goods and services, that too the final good and service only without including any transfer payments, and government produced goods are included, owner occupied houses are included, but the labor which is not sold, means people doing their own repair works at home for which no payment is being done, that labor work for which is not a sold one, typically not included. Any kind of byproducts that are coming out of the production process which are not typically sold, it could be a damage or it could be an economic benefit to the society, but they are not included as a part of GDP computation, like pollution that may come out, or some kind of cleanliness that may come out, some kind of access to good hygienic facilities that may come out. All these things, they are not included as a part of the GDP computation. So typically the GDP is one of the important measures of the economic activity of the country, and probably one single number which drives how the country is as a whole is performing vis-a-vis its previous years, vis-a-vis the other countries. there is a consistency that is coming out as a part of the computation of GDP. And in general, the way the GDP is looked at is either from an expenditures perspective, because we said GDP is the value of goods and services that are produced in the country during a period. So the value, I will look at it either from the payer's perspective, which is what we call as expenditure approach, or the receiver's perspective, because someone who has paid, the recipient is someone else. So either I look at it from the payer's standpoint or from the receiver's standpoint. So whenever we are talking about the payer's perspective, we call it expenditure approach. So all kinds of spending that has been done during that particular period is, if I'm summing it up, I call it as an expenditure approach to GDP. So all the final outputs, either I can take all the final outputs and add them up, or as I said, yes, if I am taking the raw material, the purchase cost of the raw material, and then created intermediate good. Now purchase cost has already been included. So if I am selling this to someone, this intermediate good to someone who is using it in the production process to typically come up with a finished good, because I have included raw material as a part of the expenditure already, when I'm using it to convert it into an intermediate good, I will take only the value addition between the two. The difference between the two is the value added. So I'll include only that much when as intermediate good is sold, and again I'll include only the gap if the finished good is being sold. So that is what we call as the sum of value added mechanism. So expenditure wise, the spendings of all spendings of the entire country are taken into consideration, but we have to make sure that double counting does not happen at any stage. Similarly, on the other side, we can look at it from the perspective of the recipients of that overall value. So we see generally the recipients are four broad categories. The factors of production, those factors which are going as a part of the production, they are the recipients. There could be some kind of recipients based on the land, some on the labor, then capital, physical capital, and finally the business or enterprise. If you see, the different kinds of recipients could be this. Either the companies could be the recipients of the amount, the value. Companies might have sold something and they might have received something. The land would have received, land again is owned by the individuals and individuals are the recipients, but based on the land there could be some kind of rentals that could come out. Based on the labor there could be some kind of wages that could come out. Based on the capital, that there could be some kind of interest that could come out. All these things are contributing towards the different kinds of receipts. So the summation of all these things is also equal to the GDP, and both of them should give me the similar kind of result. Both the approaches should result in the same value, because at the end whatever is paid by one source is what is received by the other source. So the payments, whether I look at it from the total payment approach or the total receipts approach, the overall summation should lead me to the same number. Right? Now, the next important point in this context is, okay, GDP is the measure of the value of goods and services, but again this measure, right, when I'm talking about the value of goods and services, typically it is like price multiplied by the quantity, right? Now, because any value of a good is measured with the price multiplied by quantity, and after that I sum up all of them to typically arrive at either from the producer, either from the payer's standpoint or from the receiver's standpoint, what is the total value they have incurred. But Here, in general, the GDP is quoted in this particular manner. Now, every year, period over period, this may change, even this may change. This is when a quantity is changing, it talks about the growth of the economy. It's a result of economic activity. But when the price is changing, it is a measure of inflation, right? If the quantity is not growing, but only the price is growing, still the GDP is going to grow up. But that's not a measure of the real growth of the economy. But in general, what we see is the GDP is expressed in the nominal terms only, which means it will take the current price multiplied by the current quantity to typically arrive at the overall GDP value, which means it includes a growth factor as well as the inflation factor. So that is where probably if I take out the inflation, which means I fix the price. I fix the price and look at the quantity, and based on the new quantity produced in the current year, but take the price of some base period. So fix the base period, and based on that prices of that base period, compute the overall GDP by taking the quantity of the current period, and that GDP is called real GDP, which means the price increase that has come from that base year to this year, which is a measure of inflation, is not taken into account while computing the real GDP. And we could clearly make out here the GDP deflator is nothing but the way you can convert the nominal into real. So it's as good as saying real GDP by the nominal GDP is what is the GDP deflator, because it talks about the same quantity, the current quantity. I look at based on the current price, and I take it based on the base price. I take these two. It is the GDP deflator. By whatever extent the nominal GDP has to be divided, the GDP deflator, I'll get the real GDP. So probably here also you do the inverse. Nominal GDP divided by the real GDP. That is going to be the GDP deflator. By what extent the nominal GDP should be divided to really arrive at the real GDP. It's a relationship between the nominal GDP and the real GDP. And in some cases, we even compute the per capita GDP, which is nothing but per head. So I take the real GDP and divide by the population of the country, which talks about per capita, which means per person, what is the kind of the value of the economic activity in the country. So that talks about the standard of living of the people, the well-being of the society. Each person in the society on an average is typically computed as a part of the per capita GDP value, right? Now, one important thing which we really need to understand is whether we are using the expenditure approach or the income approach, the overall GDP that is computed, especially removing the inflation impact, the real GDP, it should lead to the same kind of value, because at the end it's the GDP of the country. And we know spending wise, when I am looking at it from the expenditure perspective, the thing which we take into consideration is the spending that is done by individuals for consumption purpose. Then whatever is left, probably they could do some kind of investments out of it, right? The investment, whatever is the spending that has been done towards the investments in business. Then sometimes the government spends something, and then the some portion of it, see, some portion of it is consumed by the individual, some portion is exported, and some portion is invested, some portion is imported. So the net GDP that comes through the expenditure approach, we say that the amount that is spent on consumption the amount that is spent on business investment, the amount that is spent by the government, and we are talking about the value of the exports minus the value of imports. Otherwise, these two together is called as the net exports. So this is how we compute the real GDP based on the expenditure approach. But when I go with the income approach, we are talking about, first of all, the income that is received by various factors of production, which is called as a net income. The income that is received by various factors of production during a particular period. What are that? The land receives rent. The employees or the labor receives wages. The capital receives interest. The business or an enterprise receives profits. And any unincorporated businesses, right? Any unincorporated businesses like proprietary kind of businesses, sole proprietor kind of businesses, whatever the profit that comes, that goes to the business owner itself. That's not treated as a part of the wages. So those kind of individual self-owned kind of businesses which are not incorporated as enterprises, the profits that are owned by them, and the income that is coming to the government either in the form of taxes, any kind of taxes, and of course because the government provides subsidies, the net of the taxes and subsidies is the income that the government receives. So all these things put together is what we call as the national income of the country, right? So the national income is income that is coming to various factors of production, and that is added with a capital consumption allowance, because there could be a lot of fixed assets that are purchased long back, but they have been using, let's say a building has been purchased 10 years back, but the building is being used in the current year. So any kind of physical assets that are being there, physical capital that is being there, the depreciation associated with it also is a kind of is also a kind of income that is associated with the current period. So that's the reason, that is what we are calling as capital consumption element. That particular portion associated with the consumption, we are treating it as a part of the capital consumption allowance, because that's also virtually something going to some specific, it is treated as an expense, but in reality the cost of it has been incurred long back. So capital consumption allowance, talking about the depreciation of the physical capital during this particular period, and there could be a kind of statistical discrepancy that can come out, because the data that is being used for the computation of the GDP using the income method as well as the expenditure method is different. The difference is what is coming out to be the statistical discrepancy. Of course, that adjustment is needed, because whatever the GDP that we are computing using both the approaches should lead us to the same value. So this is how we compute the real GDP, where we just take net income, we add up the capital consumption allowance, and the remaining portion goes towards the statistical discrepancy. And what we say is, when I look at it slightly from a different dimension, the income, what are the different sources of income that can come out from the total? Some portion of it can be consumed, some portion of it can be saved, and what is the other portion of the income? If I am looking at the total income, whatever is the consumption related, that's an income. Whatever is the savings related, that's the income, and the net of taxes. So this entire thing is what is the total income. And from the expenditure perspective, consumption plus investments plus government spending plus exports minus imports is the total expenditure. We have to understand here the consumption part, then the savings part. Some portion of it is consumed, some portion is saved. The total income, whatever the person gets, and some portion is paid in the form of taxes. The overall income, if I look at the breakup, or he must have received some portion in the form of transfer benefits. So the net is what he is paying in the form of taxes, transfer payments. So this is what is typically getting paid in the form of taxes, right? So in this, if I look at the personal income per se, out of this entire thing, whatever is being received by the individuals. So in the net income, okay, this could be received by individuals, fair enough. This could be received by the individuals, fair enough. The interest could be received by the individuals because at the end they are the lenders, but any portion of the interest that is received by non-individuals, that will not be included. The profits of the enterprise, they are not included, but out of that profits, whichever are distributed in the form of dividends to the individual investors, that is included. That's the reason from the net income I am subtracting the undistributed corporate profits. In case the interest is not going to the individuals, then I subtract that portion of it. But for all the individual lenders, the interest is the income they are getting. The profit that is typically made by the business owners, the business enterprise based profit. Business owner is still again an individual, so this counts as a part of the personal income. But whatever the government is receiving in the form of taxes, so all the taxes that the government is receiving, that would not be included as a part of the personal income, and any kind of taxes that are typically the corporate based taxes, not the individuals taxes, but the corporate tax, even that should not be included. That's the reason we are making a small adjustment to the net income by removing these three elements, and we are adding the transferable payments, government transferring some benefits to the individuals in the form of social welfare benefits, unemployment benefits, etc. They are also acting as the income to the individuals, because here we are saying they are more like subsidies, some kind of benefits the government is providing to the individuals. So that constitutes the personal income, which is before tax, because after, if I remove the tax portion of it, we call it as personal disposable income, which is that amount which is available to the individual to really save or spend. So basically, the overall income, I'm breaking it into three parts. The taxes, after taxes, whatever I'm seeing it should be the composition of only consumption and spending. So it is talking about, the whole thing is talking about the amount that is available, or the ability, what portion of it the individual is willing to save, what portion of it the individual is willing to consume. So this is the very basic that we really need to be comfortable with. Then if I try to combine these two approaches, if you see here, C plus I plus G plus X minus M, that is going as the expenditure approach. The total income, whatever is consumed, whatever is saved, remaining is paid as a part of tax, and any kind of transfer payments received are removed from it. Now if I am doing some kind of simple mathematics on it, I get it as S, which is the savings, is equal to I plus G minus T. This T minus TP, let me take it as net T itself, net taxes. So G minus T plus X minus M. It's a very important relation. G minus T is talking of government spending minus government receipts, because tax, net tax is a see, when we are talking about the total consumer's income, total individual income, we said this is how the income is broken into. Either he can consume it, or a portion of it he will save, and a portion of it he will pay as tax. So tax from a government's perspective, it's a revenue, it's an income to the government. So this net is what we call as fiscal balance. right? Government spending minus the government income. Government expenses minus the government income we call as the fiscal balance. Exports minus the imports we call as the trade balance. So whatever we are saying, the saving which is done by the individual is a composition of the investment that has been done plus the fiscal balance and the trade balance. Now, spending minus the receipts. If it is negative, it means that the receipts are more than the spending. So the budget for the company, for the government is in surplus because it is receiving more than what it is spending. And if it remains positive, it means spending is more than the receipts, which is a clear indicator that the budget is in deficit. Now, what happens if this is in deficit? So G minus T is positive. Either it has to go with S minus I or it has to go with M minus X. So M minus X is import should be more than the exports. So it should go with the trade deficit as well. Right, the funding for this excess budget deficit should go with the trade deficit, or it should go with the excess of savings over the investment, or a combination of these two. This is a very important relation. The budget deficit that has come out, it should be financed by trade deficit and at the same time excess of savings over the investment, some combination of these two. And now, when I look at each of these individual components, the consumption part, it is purely dependent on the personal disposable income, C plus S, right? Because out of the total income, T is gone for taxes. So post taxes, if I am looking at the income of the person, it is just C plus S. So some portion of his income is C, is for consumption, and for some portion is for spending, for saving. Now, what for every additional dollar that is generated, what proportion of it is going for consumption, what proportion of it is going towards saving, are called as marginal propensity to consume and marginal propensity to save. Right, the portion of that additional income which is used for consuming, we call it as marginal propensity to consumption, MPC, and that portion that is used for saving is being treated as marginal propensity to save. The summation of it should be equal to 100% or 1, because whatever is not consumed, it has to be saved out of the total personal disposable income. So if the personal disposable income is increasing, C and S generally both of them can go up, which is resulting in the overall GDP going up through this expenditure approach. Similarly, when I am talking about the investment, investment is a function of the profitability. If we are expecting more and more profits in the future, more would be invested today, and along with that, the cost at which the funds are available. See, the expected profitability is purely dependent on the economic output, how well the economy is going to perform in the future, and the cost of capital purely is based on the real interest rates that are available at this particular point in time for different time periods of investment. And when we are looking at government spending, yes, they may spend irrespective of the economic activity, they may spend for the welfare of the people even if the economy is not doing well. But generally, their tax collection part is purely based on the economic activity itself, because they would be able to collect more and more taxes. If the economy is performing well, they may have to waive off some of the taxes in cases of poor performance by the economy as such. So the overall fixed fiscal balance, which is the G minus T, though G is not dependent on the economic activity in the country, T is very much dependent on the economic activity. So overall fiscal balance also is dependent on the economic activity in the country. Then looking at the net exports, again, Exports are purely based on foreign disposable income. How good are the willing to customers abroad are willing to buy our products? So the exports are dependent on the foreign disposable income. Imports are primarily dependent on the current the domestic country's personal disposable income, because if there is more and more income, then probably I may buy some products from abroad, which could increase the imports. And at the same time, the prices of a particular good or a basket of goods in both the foreign markets as well as the current market. Now, all these things are typically impacting the consumption, investments, government expenditures, exports, imports, finally working out on the overall GDP of the country. Right? Now, the other important aspect that we would like to get in to create a good understanding of the macroeconomics is the ISLM curve. So IS is the income and savings, right? For proportion of the income going into the savings part. See, first of all, it is a kind of a graph which plots the real income on the x-axis and the real interest rates on the y-axis. Real interest rate is taken on the y and real income is taken on the x, and this is a plot for the more applicable to the goods market, not the money market. Right? I'm trying to plot a relationship between the real interest rates and the real income in the goods market. Simple. If the interest rates are higher, let's look at it. Interest rates are higher, people save a lot. Large proportion of their income goes towards savings. Correct? If the bank is providing more interest rates, people want to invest more and more, or people want to save more and more. So what is typically happening, as the interest rates are increasing, the saving portion is going up. And if the saving portion is going up, the investment portion is going up. The investment portion is going up, is going down, because out of whatever they are saving, see, some portion is saved, some portion of their savings is invested. So they are just saving, they are not investing. So as the interest rates are going up, the savings are going up, investments are going down, so the income is going down. So as the interest rates are going up, we see that the income is typically going down. So probably I could look at the graph like this. For higher interest rates, I could see a graph like this. If the interest rate is higher, the income is only this much. If the interest rate is slightly coming down, the income is going up. If the interest rate is coming here, the income is going even more up. So we see a kind of a negative or a downward sloping kind of a relationship between the real interest rate and the real income, especially in the goods market, because as the interest rates are going down, people don't save much, they want to invest it, and the more and more they are investing, obviously results in an increased income. So the saving potential is going down, so they want to consume more and more. A better way to look at it, they want to consume more and more. So consuming more and more is creating more and more income into the economy. But look at it in the money market perspective. Again, the same graph. I take real income here. I take the real interest rates here. Now, as the interest rates are going up, right now let's look at it purely from a money market perspective. As the interest rates are going up, people want to save more and more. Right? They don't want to hold more money. They want to deposit it in the banks. The demand for holding money is going down. So they are bringing the money into the banking system. the more and more we know the quantitative theory of money, quantum theory of money, wherein we are simply talking of as the demand for holding money is reduced, more and more money is brought into the system, because and the more and more money brought in, the turnaround of the money is more higher, means the velocity at which, see, this money supply, the velocity at which the money is doing turnarounds is a proportion of the price. So what we are simply saying is, by holding M by P constant, means at a particular supply of money, at a given rate of money supply, all I could see is as the interest rates are increasing, I see that the income is also increasing because people don't want to hold more money. So overall real income is increasing, right? And at the same time, if the higher income is coming up, probably people demand for more and more money, but because the interest rates that are being offered are higher, that is again neutralizing the demand to hold money. So which means overall I could see that the liquidity money curve is typically upward sloping, which is plotted between the interest rate and the income levels. But for the same plot in the goods market, I see a downward sloping kind of a curve, which means in both the relationship between the income and the interest rate should be consistent. In the goods market, it is more and more downward sloping, and in the money market, it is more and more upward sloping. But what we are saying is both of them should be consistent, which means the intersection part is purely talking about the equilibrium level between the price and the real income for a given money supply. So this is what will give rise to the aggregate demand curve. Wherever the IS and the LM curve intersect, it is what we are talking as equilibrium in both the goods market as well as the money market. And that intersection gives me that particular price level, because we said we keep M by P constant. So as P is differing, M by P, if price is increasing, we see M by P is decreasing. So the money supply is decreasing. So your LM curve would be shifting to the left. Or if P is decreasing, we see that M by P is increasing. So LM curve is shifting to the right. So there are different LM curves that are coming up for different prices. So for that particular price, so when I'm talking about this particular, for a particular money supply where we are talking of M by P being constant, we are talking of the relationship between the price and the real income. And that is what we are bringing out as the definition of the aggregate demand curve. So we are keeping the money supply constant. As the price is increasing, we see that the M by P will change. The LM curve will shift either to the left or to the right, which is resulting in the higher interest rate. If I am talking of LM curve shifting to the left, it is resulting in the interest rates being higher and the real income being lower. If it shifts to the right, we see that the real income is higher and the interest rates are keeping lower. So this is where we are trying to bring in the concept of aggregate demand, wherein we are talking of the relationship between the output demanded and the price. So here I am taking the output and here I am looking at the price, and it's a downward sloping relationship. Why? As the price is increasing, see, people consumption power is going down. So the real wealth of the people is actually going down, because whatever because the prices are going up, inflationary economy is there. Whatever is the real wealth that the post the inflation, whatever is the real wealth that is there, that is going down. And so which means earlier the LM curve was like this. Now if the prices were decreasing, the LM curve would have shifted to the left. So the new thing is the interest rates. Now if I look at it from an LM curve's perspective, the interest rates have gone up compared to the earlier. the real interest rates have gone up, the output has actually gone down, which means the country is performing below the potential GDP, and the domestic products are becoming more and more expensive because the price has gone up. So the domestic products are getting more and more expensive, which means the demand has actually gone down. So as the price has increased, the domestic output has gone down, and which is again reflected in the demand for the domestic goods typically going down. So whenever we talk about the aggregate demand, we are looking at it purely from the expenditure levels which are done by four different parties: C plus I plus G plus X minus M. Different parties, their spending powers, which could either increase or decrease the aggregate demand. But look at it from the other side, the supply. Again, how much output the suppliers are willing to supply at different levels of price. Keep the other input factors constant. So whatever, if the price is increased, what is the output that is produced? See, in a short run, probably very short run, I see that this relationship is perfectly horizontal, perfectly elastic, because even if the price increases, there may not be any change in the output at all, or even if the output has to increase, the price will not be really changed at all in the short run, right? Some adjustment will happen even if the input prices are increasing. Even if the output price is increasing, we see that some adjustment is done through the labor, efficient usage of the labor, overtime usage and all. So the price will not really change for whatever is the level of output in the short run, which means we see that it is perfectly elastic. Whereas when we are talking about a short run, not very short run, but a slight short run, we see that as the price is increasing, output price, right? Here I am looking at the output price. Generally, in a very short run, some input factors are constant, right? Some input factors are constant, some input prices do not change. Probably the labor costs in the short run, they do not change. Are probably the raw materials costs in the short run, they do not change, but the output price is going up. Now what will happen if the output price is going up? People think, the business thinks that yes, the input prices are not changing, but the output price is gone up, so there is a scope for making a bigger profit. So they want to produce more and more quantity of the output in the short run, because input prices don't change. So they want to take an advantage of the difference between the output price and the input price, and they want to produce more and more in search for higher profits. So that's where in the short run we see that this aggregate supply curve is slightly upward sloping. Whereas in the very short run, even if the output price increases, whatever is the whatever is the increase in the output price, the quantity, whatever they produce, the price generally does not change. The output price, they don't want to increase. Even though there is an output price in the very short run, whatever is the quantity they are producing, they try to fix the price, they try to adjust the labor capital and try to freeze the price itself. But in the short run, we see that it is upward sloping. Whereas in the long run, yes, in the short run, the supply is going up in search for profits. But in the long run, we see again it is perfectly vertical. Whatever is the price change that is going to come up, the country cannot produce or sell output beyond a particular point, and this particular output is what is called as the full employment output or full employment GDP. Anything, the production cannot grow beyond that particular point in the long run. That is the full potential GDP of the country in the long run. So in the long run, we see that the supply curve is perfectly inelastic, a vertical curve, which is resulting in three different supply curves in response to the price changes, price of the output changing versus the quantity of the output that is supplied. But of course, any price changes apart from other factors, if it is a price that is increased or decreased, we see that it's a movement on the curve and not a shift. So the shift in the curves can come out because of various factors. That is what we would typically see. Now let's look at the aggregate demand curve. Under what conditions it can really shift. We have seen that this is the aggregate demand curve, right? And we have already discussed that the aggregate demand is purely coming by the expenditure that is done either by consumption or businesses or government or by foreigners in terms of exports minus imports. So anything that really changes the expenditure capacity of any of these parties will result in the shift in the demand curve. So wealth of the households, right? The salaries going up, the wealth of the people going up. Obviously, any additional income that is coming up increases their personal disposable income, and any personal disposable income going up, their consumption is going up, even their savings are also going up. And because the consumption is going up, we see that the aggregate demand curve will shift to the right. So if the wealth of the households is falling, the aggregate demand curve will shift to the left, otherwise it is shifting to the right. Similarly, from the business's perspective, the future sales, future profitability of the business, if it is expected to grow, whatever the particular industry or a business, if the future profitability is expected to grow, people would like to invest heavily in that particular business, which means the I is going to grow, which will shift again the aggregate demand to the right. Future salaries, future income, if the people are positive about their growth in the future income, they want to deposit more and more, they want to invest more and more, they are consuming also more and more because they are very much sure about they will make money in future. The business the salary prospects are looking much brighter, the employment scenario is looking much brighter, so they may expect to consume more and more today. But if they are very gloomy about the future, better they try to save more and more, so the consumption levels will go down. So we have to see from any of these participants' perspective, is C or I or G or X minus M, is it going to go up? If that is the case, the aggregate demand curve will shift to the right, otherwise it will shift to the left. Similarly, capacity utilization by the companies. If the companies are operating at very high full capacity levels, what we could very well see is they try to invest more and more, so that the more they are going for, the more output they are producing, the more and more economies of scale they can generate. So they are going to invest very heavily, which is resulting again in the aggregate demand curve being shifted to the right. And coming to the government perspective, the policies which the government implements, the monetary policy, so it is increasing the money supply. So money supply is very high. If it is expansionary, then money supply is going to increase. If it is contractionary, the money supply is going to decrease. So if the money supply is increasing, obviously the banks are having more and more money with them to lend, so they have to reduce the interest rates. And if they have to reduce the interest rates, obviously the businesses will try to borrow more and more. So which means the businesses are going to expand. The businesses going to expand, is the investment increasing, which is shifting the aggregate demand curve to the right. Even if the interest rates are much lesser, individuals feel, let's consume more, because there is no point in saving. We are not getting any interest rate when we are saving our money. So obviously we will also consume more and more. So the consumption levels also typically go up, further pushing the aggregate demand curve to the right. So if the government is following an expansionary monetary policy, we see that the aggregate demand curve as well. Aggregate demand curve shifts very well to the right because both the investment as well as the consumption potential typically goes up. And at the sorry, same time, look at the fiscal policy. Fiscal policy is planning out the G minus T. Now, if it is expansionary, right? If it is an expansionary, means the government is spending more and more, collecting lesser and lesser. G minus T is actually going up because either the government will keep spending more and more, it will collect less and less. So whatever, even if the taxes are going down, we see that the personal disposable income is going to go up, which is resulting in the AD curve shifting to the right. And at the same time, if the government is spending more and more directly in the formula itself, G is increasing, so the aggregate demand is shifting to the right. So wherever you have to understand whether the aggregate demand curve is shifting to the right or to the left, is there an increase in the aggregate demand or is there a decrease in the aggregate demand? If we have to understand these things, just try to plug in these various factors, see if there is going to be any increase in C, I or G or M, X minus M, which is directly going to help us out in understanding whether the demand curve is going to shift or not. Similarly, look at the exchange rate. If the domestic currency is depreciated, right? Domestic currency is depreciated, exports are going to increase because the local products are becoming much cheaper. So the exports are going to increase, the imports are going to reduce. So X minus M is going to increase, which is again going to shift the demand curve to the right. But if the domestic currency is getting appreciated, then the domestic products are becoming more and more expensive, whereas the abroad the foreign goods are becoming much cheaper. So imports will be higher, exports will be lower, resulting in aggregate demand curve shifting to the left. Similarly, if the global economic growth is happening, from the country's perspective, more and more purchase of the foreign goods can happen, right? Or exports to the foreign countries can happen. So depending on if the country is able to export very heavily to the foreign countries, then again the demand curve is going to increase and shift to the right. So these are the various scenarios which we can see where the aggregate demand curve shifts. It has nothing to do with the price, various other factors which are impacting the consumption or investment or government spending, exports and imports. Now, similarly, when we look at the short run aggregate supply curve, we know that the short run aggregate supply curve, right here I'm talking about the real income, here I'm talking about the prices. We said that it is slightly upward sloping, right? The real income or the real output, in the short run it is going to be upward sloping, and we know that in the short run many input prices are constant. Now if the overall long run GDP itself, potential GDP itself has changed, obviously the short run also is going to get shifted to the right. If the potential long run has gone up, even in the short run, which means the base, which is that long run GDP has gone up, so even in the short run there would be a shift in the supply curve. But other things, wages falling. In the short run, let's say if the wages are falling or relatively the wages are lesser, people want to produce more and more. More and more production, output is increasing. So it will shift to the right. If the wages have fallen in the short run, immediately we see that the supply curve shifts to the right. And at the same time, productivity of the labor has gone up. They will produce more and more and the output is shifting to the right. Future prices of the output, if there is a positive signal that in the future the output is going to increase, the prices of the output are going to increase in future, people want to produce more and more today because in the future they are going to get much higher income for the output that they are producing. So the output production quantity is going to go up. In these cases, the GDP or the aggregate supply of the country, the GDP is going to be much higher in these kind of situations. Similarly, if the taxes are incurred heavily, the producers don't want to produce much, which will result in aggregate supply curve shifting to the left. But if the government starts giving more and more positive subsidies, more and more heavy subsidies, producers want to produce more and more because what they are getting in net is much higher compared to the cost they are bearing. So obviously it results in a supply curve shifted to the right. And currency wise, if there is a heavy depreciation in the currency, we see that the exports are becoming much cheaper, imports are becoming much costlier. And if the imports are becoming much costlier, the raw materials, let's say if some of the raw materials are imported, the cost of the raw materials is typically going up, and the costs are going up. Obviously, the production levels are going down, which is resulting in the supply curve again shifting to the left. So in the short run, we see that the aggregate supply curve responds to all these things, something to do with labor in terms of their wages or productivity, some kind of expectations about the future, some kind of expectations relating to the government policies in terms of taxations and subsidies offered, and a few things relating to the currency in terms of depreciation or appreciation. And similarly, when we are looking at the long run aggregate supply curve, we have already discussed the long run aggregate supply curve is perfectly vertical, and this is like potential GDP. So anything that is affecting the long run potential GDP only is going to so any change in the real output or the full employment output is really going to impact the long run supply curve. The quality of the labor, the quantity of the labor, if it is a permanent increase, so more labor or more skilled labor obviously are resulting in the overall potential GDP going up. So either the labor is becoming more and more productive through various trainings, through high level education, through some kind of technology based learnings. So the productivity of the labor drastically going up, population growing resulting in the supply of quantity of labor, all of them contributing to a shift in the long run potential GDP. More and more natural resources available resulting in the long run aggregate supply, because the country is able to create very high employment opportunities, very high economic output is going to increase in the long run. Any heavy investment in the capital, some kind of physical assets being acquired at a bigger scale, again obviously resulting in the overall productive efficiency going up and the overall production capacity going up. Similarly, technology is adding up more and more to the productivity, which is again resulting in a long run shift in the aggregate supply curve. Right? Now, the next dimension that we really need to look at is the fluctuations that can come up in the aggregate demand as well as the aggregate supply curve at a time. So let's look at this. This is the aggregate demand curve. So we have here real output, and here we have real interest rates as well as the price. Aggregate demand downward sloping, aggregate supply as the upward sloping, at least in the short run. And in the long run, probably aggregate supply, long run aggregate supply, which is what is coming to the potential GDP level. Right? Now, if there is a fall in the demand, what are we saying when there is a fall in the demand? which can occur because of any of the previous situation. The demand can typically fall either because of C falling or I falling or G falling or X falling. So if the demand is falling because of any reason, we see that the aggregate demand curve shifts to the left. And because of that, what is happening? The prices are falling. Because earlier the price was at this layer, now the prices have fallen, and even the GDP is below the full employment level. In the short run, we see that the GDP is also falling. So the GDP is falling lesser than the full employment GDP, potential GDP, which is what we call as the recessionary gap, right? And because of this recessionary gap, because the production is much lesser, the employment levels are also going to go down, and because the unemployment is going up and the employment levels are going down, from the wages perspective we see that the wages also can go down, because people are ready to work even at lesser, smaller salaries. That is what classical economists say. The moment we see that the unemployment levels are going up, the way the employment levels are going down, we see that people are ready to work even for smaller wages. That is where the wages are going down. Wages going down, we have seen that the short-run supply curve is going to shift to the right. The short-run supply curve is going to increase. When there is a fall in the wages, we have talked about that the short-run supply curve is going to shift, which is resulting in the country coming back to its full potential GDP level, but of course at much reduced prices. So this is what, as the aggregate demand falls, this is what happens in the economy as per the classical economists. But what the Keynesian economists say is the wages going down is a very, very slow process, and it may not happen in some cases. So which means the better alternative for the government to bring back the aggregate demand is spend more and more. So either use a fiscal policy to get it back, expansionary fiscal policy where it spends more, collects less of tax and bring the aggregate demand back, or come out with an expansionary monetary policy where it is literally bringing in the money supply, resulting in a reduction in the interest rates and the investment activity growing in the country. So that is what happens with a fall in demand, aggregate demand, and this exactly reverse happens with an increase in the aggregate demand, right? Because the aggregate demand is going to shift to the right here. We see that the price is increased, the GDP is above the real GDP, or potential GDP, which means we are seeing a kind of an inflationary situation and prices are going up. So because the output is more than the potential output, competitors are now fighting for their pie. So they want to sell it off even at a reduced prices. And even because they are producing more and more, the wages also, the demand among the workers also typically goes up, and that results in a short run aggregate supply curve shifting to the left, which is resulting in a prices even more going up, but the output coming back to the full employment. Now, if I look at comparing this situation with this situation, one, the output has come down, two, the prices have gone up. That is a situation of stagflation. Output is decreased, prices have gone up, a kind of a stagflation scenario. So this is where the governments have to be very careful of. When there is an increase in the aggregate demand, it is resulting in the prices increasing even more, because the moment aggregate demand has increased, shifted to the right, prices have gone up, and to address that particular prices, short run aggregate supply has gone down, which has still pushed up the prices. Prices are going down as the aggregate demand is going up. But if the government is trying something to decrease the aggregate demand, it is resulting in the GDP falling even more further. So it's a very tricky situation for the government to handle. So that's the reason, decrease the prices of the inputs. Labor price you decrease, or raw materials prices you decrease by addressing the inflation, targeting the inflation. That is a better alternative, and which is what is resulting in a very slow process as well. Now what we could see is, just to understand, if the aggregate demand is increasing, just now a simplified summary, aggregate demand is increasing, prices are up, the real interest rates are up. And from here, we are seeing that the real GDP is up. Because the GDP is up, the unemployment levels are down. Right? Now, which means probably I should look at it like this. Increase in the aggregate demand. If I look at the real GDP, yes, it's up. Unemployment, it's down. Prices up. The real interest rates are also up. Now the same logic if I put for aggregate supply, right? Just forgetting about the aggregate demand, if the aggregate supply is shifted to the right, I see that the GDP is up, unemployment is down, the prices are falling, and the real interest rates are falling. Now I can combine. What if both of them get impacted at the same time? Aggregate demand is up, aggregate supply is up. Okay, both of them are up. I see that the GDP will definitely be up, unemployment will definitely be down, but I'm not sure about the prices because one of them is up, the other one is down. So the net, I have to see by what extent, what is the kind of elasticity, or by what extent aggregate demand is shifted to the right compared to aggregate supply. And the same thing I have to talk with respect to the real interest rates as well. Similarly, when I look at it from the different dimension, the aggregate demand is up and aggregate supply is down. Right? Aggregate supply is down. Obviously, it is resulting in a price inflation going up because in both the cases, the prices are going to go up. The interest rates can go up, but we can't talk too much about the GDP and the unemployment because one is going to go up, the other is going to go down, and the combination may not create any kind of a clarity. So better we can do it using the diagrammatic form, or just using this kind of a table. If both the things are resulting in a parameter resulting in an upward movement or a downward movement, we can say definitely there is going to be an uppish movement. Otherwise, we cannot talk about any kind of an upward movement, right? So this is one more dimension that we have to look at. Any combination, aggregate demand increasing, aggregate supply increasing, decreasing, what is the kind of impact that it is bringing. Now, the next dimension that we really need to look at is the growth. See, we have till now looked at how the outputs are changing, how the prices are influencing, and now we are looking at economic growth. So the economy growing is nothing but the GDP growing, long-term GDP growing. So the economic growth is contributed very heavily by the labor force, more and more people coming up, population, more and more population increasing, the labor force will increase, more people coming from outside and settling in the country, the population is increasing, more people participating in the growth of the country, the labor is increasing. All of them are contributing to the economic growth. And the more and more people coming into the employment process resulting in an increase in the employment percentage is definitely contributing to the economic growth. The unemployment levels growing up is resulting in a fall in the economic growth, but the employment levels growing up obviously is resulting in an increase in the economic growth. Similarly, not just the number, but the quality, the productivity of the labor force. More highly educated, efficient training programs happening, skill levels growing, obviously is contributing very heavily to the economic growth. Similarly, the investments in the physical capital, right? More and more technology investments, more and more machinery, equipments, which are improving the productivity of the labor, and that productivity is improved obviously is causing the potential long-term GDP going up. The long run supply curve is also shifting to the right. So heavy technology, heavy growth in the technology obviously is going to add up more and more to the growth of the economy. And even the availability of the different types of natural resources, more availability, more growth is coming up. These are the ones which will contribute to the growth in the long run. So whenever we talk about the definition of the potential GDP, we talk about the number of hours, labor hours of effort that is being put multiplied by the productivity. So anything that contributes to the growth in the labor hours, that is like supply of the labor, or the productivity which is going up by any of these, education, investment, technology, resources, all of them are adding up to the growth in the productivity. So any of these two things growing obviously is contributing to the growth in the potential GDP. And what we are talking of is the sustainable rate, because that is what every year over year, at what rate I can assume that this particular economy can grow. It's just not a 1 year wonder. It's just not a 1 day wonder or a one small period wonder. I want it more and more to be consistent growth rate, not an ad hoc growth rate. Because the equity investors, the equity investments in that particular country, or even any kind of debt investments in that particular country, depend very heavily on how consistently the country's economy is growing. So, on a sustainable mode, what is the rate of increase in the potential GDP? That is very, very important factor for the country, because long run returns associated with equity, debt, any kind of investments in the country heavily depend on that relationship. So, finally, talking about the production function, which is one of the major approaches to analyze the sources of economic growth. We have talked about the economic growth coming either because of the labor, because of the capital, because of the productivity which is coming in, either because of mostly because of technology, labor coming in more from the quantity of labor as well as the productivity of the labor. Similarly, when I'm talking about the capital, it could be physical capital or natural resources. All these things contributing to an increase in the output. So we are trying to establish it in this way: the output, technology multiplied by a function of labor and capital. Sometimes the growth per capita, if they have to look at, people started designing it as the technology multiplied by the function of K by L. So capital per labor. And whenever we are talking of A, which is more associated to the technology, we are simply looking at the economic growth which is not contributed by the capital and the labor, which we can't directly observe, but we can very well bring in that it is a growth. That is why we call as total factor productivity. It's just not one factor. Overall, the improvement in the factors is coming up because of the productivity that is getting generated because of the technology or any other thing which I cannot directly attribute to labor or capital. And what we see is, yes, it can't keep going up and up. As K by L is increased, I can't see that every time the output is going to increase, right? Because it follows a marginal productivity. More and more investment in the capital, it, yes, obviously it will increase the K by L ratio, which will definitely increase the productivity, but the growth in the productivity is on a marginally diminishing basis. So after a certain point, any kind of investment in the capital deepening investment may grow the economy, may result in an economic growth, but at a very diminishing rate. So that is where the technology plays an important role, because this may keep increase, but at a very diminishing rate. So what has to really provide oxygen here is this part, which is the contribution of the technology, especially for developed countries, which might have already been at a peak of this particular ratio. So for developed countries, more and more investment in technology, more and more robust technology, more and more developing technology is really going to contribute to a higher rates of economic growth compared to investment in capital, because they are already at the peak with respect to capital per labor. So not just the capital deepening, but the productivity gain as well as the labor force. Even the number of people should keep increasing. Otherwise, it cannot result in a rapid growth in that particular country. So that's the reason the solo model or the typical neoclassical model says growth in the potential GDP. Look at it like technology growth plus look at the total share of the labor in the net income. So probably whatever is the net income, look at it as the proportion of the labor in that net income, multiply it with the growth in the labor. Similarly, take out of the net income whatever is the growth created by the physical capital multiplied by the growth in the capital. Now, if the particular economy is having a heavy proportion in capital, obviously an increase in the capital growth is definitely resulting in overall growth in the potential GDP higher. But for those countries which where the labor is a bigger workforce compared to the capital, or labor is a big contribution of the net income compared to the capital, the focus should be more and more in increasing the growth in the labor, which will contribute higher to the potential GDP, right? So a detailed understanding of these various dimensions of aggregate output, the prices, economic growth is very much required to create a base or a hold in the macroeconomic function of the country, right?